Hello and welcome to a CMS Forex morning video brief. I'm your fundamental market analyst, Nick Nassau. Today is Tuesday, August 10th, 2010. The dollar strengthened broadly today as investors turned away from currencies most tied to the pace of global growth after we had a report indicating slowing domestic consumption in China. I will take a look at that report as well as some other data out of the UK and take a look at market sentiment heading into the FOMC announcement scheduled for 2:15 p.m. Eastern. I'll be back in the afternoon to recap the developments following that announcement, but wanted to update you with what had happened overnight first. So let's get to it. China's trade surplus reached an 18-month high in the month of July as exports rose to a record and while import gains slowed. The gap surged 170% from a year earlier to 28.7 billion. Exports increased 38.1% compared to a year ago, while imports advanced 22.7%. Now, while exports grew at a pace stronger than expected, the weak import growth struck a discordant tone over the Chinese economy and raised concerns that softening Chinese consumption could have negative implications for the global recovery, which sent growth-sensitive currencies lower. For instance, let's take a look at the Australian dollar versus the US dollar, and we see following a labored rally in the last 5-6 sessions where we reached the 0.92 level, in today's trading we had a rather sharp slide. We came in at around 0.9164 and fell all the way down to 0.9050, an old level of resistance turned support from about 2 weeks ago. So we can see that we had paired this full rally we had seen over the last 5 days as we had risk aversion following the Chinese data. The weak Chinese report also hurt equities both in Asia and in Europe, which increased the sense of risk aversion and helped the US dollar to gain against these commodity and growth-linked currencies like the Australian dollar and Canadian dollar. If we take a look at the US dollar Canadian dollar, we see that we had set up at resistance at 1.03 yesterday, had tested that level, but we were mainly consolidated in yesterday's session. Today, however, with the increase in risk aversion and investors seeking safe haven in the form of, let's say, the US dollar, we saw this pair break above 1.03 and climb to the next level of resistance just below 1.04, around 1.0380, which was our resistance back here during this consolidation zone in late July. And as you can see, we've come to rest there at around 10:30 a.m. Eastern, which is when I'm filming this video. So we have about 4 more hours before the FOMC announcement. Now, U.S. equities also opened lower following what we had seen in Europe, and oil prices were down about $1, so all of that hurt the Canadian dollar in this pair. Now, we also had some weaker than expected data from the UK. First, we had the BRC Retail Sales Monitor for the month of July show a gain of 0.5% compared to 1.2% increase in June. That rate of growth in retail sales, therefore, was less than half of the month prior. Sales of food and clothing was up, but sales of durable goods, such as furniture, declined sharply, so that means that consumers were less willing to spend. The news also dovetails with the RICS house price balance, which came in at negative 8% compared to the forecasted 5% expected. It was the first decline in prices for a year in the month of July as demand for homes fell, which is a sign that the economic recovery may be losing steam. Now, what this indicator measures is a net balance of the number of real estate agents and surveyors which say that prices are falling compared to gaining. Now, to counter that weaker retail and housing data, we did have a positive trade balance report from the UK where the trade deficit narrowed more than economists had forecast in June as exports rose to a 2-year high. The goods trade gap shrank to £7.4 billion, or around $11.7 billion, from £8 billion in May as exports jumped 4.3%, to their highest level since June of 2008, and imports rose 1%. But still, taking a look at the pound-dollar pair, the trade data wasn't enough, and we saw the pound sliding rather sharply. We came in at around 1.59 and fell all the way down to 1.5710, so a change of almost 200 pips. We had the decline start overnight as a result of the Chinese data and then extend in the middle of European trading and in New York morning trading. We had seen this pair in last week's trading run up against resistance first at 1.5960, break that briefly, but then resistance at 1.60 held, and with the pair unable to move upward, now we're seeing it move downward instead. Now, the rally has been very strong in the pound pair over the last few weeks, but given the austerity measures facing the UK economy in the second half of the year, growth will be much more challenging than the market believes, which makes the rally in the pound somewhat suspect. The weaker data we saw today in housing and in consumption comes on top of some slowdown in services and manufacturing. There was also some weak demand for an auction of UK government bonds today, which added pressure to the pound. However, that weak demand for those government bonds may have come as due to the uncertainty ahead of the FOMC meeting. In any case, putting all that together, we see that we have cracked this upward sloping support trend line, which had corresponded to our 100 period simple moving average, and in today's trading we even moved below the 200 period simple moving average in the 1 hour time frame. So we are now in the process of retracing this rally that had started on July 22nd, breaking below the 23.6% area and perhaps approaching the 38.2% area. Similarly, if we take a look at the pound-yen pair, we saw the pound sliding today as the yen gained as a result of risk aversion and the falling equity prices around the world. Now, we also had a break of our upward sloping support trend line from July 22nd, and we also broke our 200 period moving average, and we see all of our moving averages actually converged here as we consolidated in this downward sloping channel, and in today's session we moved down to the support of that downward channel. So we see the markets in a state of caution and risk aversion ahead of the FOMC interest rates decision and statement, and I'll be back in the afternoon with a look at that statement and the reaction in the markets. So for now, that was a morning video brief. Thank you for watching and hope to see you later today.